There's a lot of uncertainty over what comes next. The administration has appealed the ruling and could ask the Supreme Court as soon as tomorrow to halt the tariff block. Let's talk about the impact. Brian Levitt is here now. He's Invesco's global market strategist. On set with me is Jim Caron. He's the CIO of Cross Asset Solutions at Morgan Stanley Investment Management. So it's great to have you both here. Jim, I'll start with you. Does this introduce more headline risk as the president has to decide how to reimpose or go forward? Or do you think it actually reiterates the sense of nothing much more punitive is really ever going to happen here?
Yeah, thank you. Listen, I think there's two questions here, which is goals and means. The goals of the tariffs, which is to rebalance trade with the rest of the world and the U.S., is still in place. The means at which this is going through, which is more procedural, how quickly does President Trump have this authority to do these things, is what's slowing down. So what has been disruptive to the markets was the pace at which this was all coming all at once because of these IEEPA, protocols that were in place where he could just make these tariff announcements very, very quickly. Now this is going to change over to more of a procedural process that is going to go through, that's going to slow things down. So the fact that it slows things down, if we go back and think about earnings reports, people would say, well, look, I can't predict my earnings because there's a lot of uncertainty. If we move more towards a procedural process of getting this done, then that probably does give a little bit more visibility. So I would say that this
is it good visibility or bad visibility?
It's probably confusing visibility,
yeah.
But it does slow down the uncertainty, which I think reduces some of the volatility.
In other words, investors now know they're not going to wake up tomorrow with an IEEPA declaration of XYZ% across the board. If it's something 232 or 301, in other words, sector or country related or otherwise, there's going to be clearer communication.
Kelly, I left work on a Friday thinking that there were going to be tariffs on Europe. I woke up on a Monday saying that wasn't going to happen. So I think that goes away.
I think we all did, by the way, had the same experience. Brian, where does it leave you thinking about the markets?
From a economic perspective, the policy uncertainty persists. So it's still going to be hard for businesses to put plans in place. It's going to be a bit of a challenge for consumers. So I don't think that changes. But this is a market that bottomed a while ago and has been looking towards incrementally better policy. And so that I think that's still the backdrop, that the worst of the policy is behind us. Things are going to get incrementally better. You probably, you still want to be mindful of the valuation in the portfolio. You still want to have optionality in the portfolio in case something bad happens. But I think far too many investors are trying to play this as a binary situation. I'm in or I'm out. And this type of news is just further recognition that that's going to be a challenge.
So what do you do? I mean, does it leave you going, hey, there's plenty of upside here for equities if it looks like, some of the big recession risk is off and we're kind of, or not? I mean, do you think you have to still stay in a pretty defensive position?
Well, I think the recession, there does not appear to be a recession coming. I mean, if you look at one of the best performing asset classes this year in the U.S. is high yield bonds. That is not consistent with a recession. So we're comfortable that the cycle is going to continue. Now, the challenge investors have is when leading indicators are rolling over, you want to be more defensive. That's quality, that's mega cap U.S. growth companies. And so it makes sense to still own there. But the challenge investors have is if something like Liberation Day were to happen again, what ended up happening was you got a pretty big valuation adjustment. So I would say diversify into other parts of the world, non-U.S., perhaps some value stocks in the U.S. Just bring down the valuation of the portfolio in case things get worse. But that could also set you up with a better policy response, a pickup in leading indicators, more of a recovery trade.
Right, exactly.
Should favor a value-oriented portfolio.